Hi, welcome to Let's Talk Bonds, the bond market podcast from INR Bonds. I'm Arjun Parthsarthi. And a huge amount of volatility in global and domestic bond deals. And this is unnerving bond investors across. But having said that, at the same time, in India, you have a very strong positive credit cycle. And how will the rising bond yields hamper the credit cycle? That's a question mark. The second is now RBI has indicated a neutral policy stance in its April policy review. And will the policy stance change to a tightening given all the volatility in the bond markets and worries about rising global inflation? And what do bond investors do in this whole scenario, right? So that's going to be the topic of the podcast. So before we get into the whole into this topic, which is going to be very important for bond investors for this year, uh, the risks in investors should understand the risks in bond market, which is the credit risk where defaults can happen, liquidity risk where cost of buying and selling can be very high, and the third is the interest rate risk where prices can go up and down. And INR Bonds is a platform by Zephyr Financial Publishers. We are a SEBI registered stockbroker and an OBPP. Now, getting back to the podcast, um, so many things, right? So we have in India, what's in the last 1 year, where has been the returns in bond markets? Clearly in the high yield space. GSEC yields have risen sharply, almost about 50 to from lows seen in the last 1 year. It's gone up by close to 100 basis points. So that's almost a 7% loss in capital gains. In the 15 and 30 year too has risen sharply, and investors have definitely lost money in government bonds. Same with the AAA PSUs and corporate issuers, where the elasticity to government bonds are very high. So yields on AAA PSUs and corporate and AAA corporates have also gone up, and investors have lost money in them as well in terms of capital price if they mark to market in terms of price loss. But having said that, India has gone through a very positive credit cycle, right? Till last year, in the up to 20, FY 25, the credit cycle was, you could have said, negative, right? You had the MFI sector, the microfinance sector, going through a huge amount of stress. You had a lot of question marks on commercial vehicle lenders. You had question marks on LAPs, MSME, SME fundings, and all that. But in the 25-26 period, there seems to be an extraordinary turnaround in the credit cycle, especially in the Q4 results, if you have seen. Now, going sector by sector, in the MFI sector, what we are seeing is that from a negative credit cycle, it's turned positive, as in the structural issues facing MFI over the last 2 years have completely turned around. A lot of positives have come out. If you look at the corporate results of large MFI companies, including Credit Access, you have the Spandana, you have Saturn Credit Care, Muthoot Microfinance, and others. You have seen that all of them have shown turnarounds. One is they've shown growth in terms of AUMs, like credit access, and issuers lenders like Spandana and Saturn have shown strong profitability as well. They have the legacy books have gone down completely, and it's all in a new book. Collection efficiency has gone up. A lot of tightening of norms. They have lenders on their own have curbed growth to make sure that the balance sheets are fundamentally stronger. And all this, and the guidance also, if you look at the guidance of all these corporates who have on the MFI sector, they have shown a very positive guidance for FY 26-27. Now, if you take the gold loan sector, gold loan lenders have seen the sharpest growth in history, and CRISIL estimates that the whole industry can touch 4 lakh crores by the end of 27. a 40% CAGR in the last 2 years. Now, that is a very strong affirmation of growth. And gold loan lenders have seen RBI regulations too have improved their credit and underwriting efficiency. And given that gold prices have increased, all of them have gained substantially because asset quality has increased, as well as the for every customer the value has increased in terms of the lending because of higher gold prices. All put together, the gold loan too have seen some very strong numbers, and guidance on two has been very positive. But have after having extraordinary year this in this financial year, that is FY 25-26, many of them have slightly lowered their expectations because they didn't want the market to overreact. And if you take the commercial vehicles, you've seen very strong growth in the used commercial vehicles. And you have the large lenders like Shriram and Cholamandalam, I'm sure, coming out with very, very strong numbers, very positive outlook, and very strong in terms of fundamentals as well in their lending profiles. All put together, again, a very positive cycle. Then you have the very large lenders like Bajaj Finance continuously showing a 25% year-on-year growth, showing positive guidance. There's been improvement in the MSME and SME too in terms of the kind of traction that the lenders have seen over the previous year. And you have the personal loan lenders, unsecured personal loan lenders that are continuing to grow, especially in the fintech space. So everything put together, you've seen a positive credit cycle. Now, one would question that where is this credit cycle coming from, given that the economy is now facing some rough weather, right? So in the global in the global front, you have seen a very sharp rise in global bond yields. The U.S. Treasuries, the 30 has crossed 5%. The 10-year has crossed 4.6%. The Japanese government bonds are at record highs. I mean, the highest in almost 30 to 40 years. You have the European bond yields rising. Clearly, there seems, because of the war in the Middle East, a huge amount of issues on energy crisis. And then you had also the Prime Minister coming and talking about austerity measures in India. And all this is giving rise to talk about whether there could be rate hike. And the rate hikes is to make basically curb consumption, right? So if they want to curb consumption, what the RBI do is tighten the cost of funds, and so that the cost of the cost of borrowing becomes higher, and typically both consumers and businesses tend to spend less, basically to save on all the resources that we have, given the extraordinary supply chain issues in the global markets. All put together, the question to ask is, in this kind of market, what do bond investors do? Clearly, in the last 1 year, those who have gone for safety have lost a lot of money. Those who have gone for higher yielding bonds have laughed all the way to the bank because they have high yield bonds, given the positive credit cycle, have done exceptionally well. You've seen a lot of rating upgrades. Your sector turnarounds. All put together, this sector has delivered returns of anything between 9 to 11%, right? Without much of volatility. And clearly, should investors continue to look at high yields, or would the worries of austerity measures and rate hikes hit the credit cycle, and there could be some more risk coming through? I think that it's a nuanced investment that investors need to do, bond investors need to do, in terms of assessing the risk, assessing the risk return profile of each issuer, rather than just turn around and say last year's high yield has done well, so this year it will do well. I think investors should look to pare down risk, see where opportunity lies. If there is, for example, if there is a sharp spike in government bond yields, is there an opportunity there? If the AAA yields are looking good, is there an opportunity there? If high yields are looking too low in terms of the yields have come down sharply, given the current economic risk that is on the horizon, if that's too low for comfort, then I think investors may want to evaluate that kind of credits. So it's best that they evaluate the whole sector, whole economy, what's happening in government bond yields before taking any calls on their high yield investments without taking just because the sector has done extremely well last year. It's best to work with experts and or take judgmental calls on the high yield bond markets. Thank you for listening in, and do let us know. Do follow us on all podcast channels, including YouTube, Apple Podcast, Spotify, and others.